If I were going to guess an article topic for CNBC or Market Watch this week, it might have a title something like August and September are usually bad, but October is the most volatile month. Woo! Isn't Halloween coming up? Really? Is that all you've got? What's an investor supposed to do with that information? My advice? Ignore it. As an investor and not a trader, you have to take the long-term view and keep investing with an eye toward your results 5, 10, or even more years from now. With that backdrop, let's look at the health of the markets right now. There are some signs that we've seen at least a short-term bottom, but what are they? Let's take a look. So if we take a look at how equities have performed over this last week, you can see we've had a very healthy rally here. In fact, all the risk assets, ARKK, small caps, NASDAQ 100, all finished higher for the week, while the safer assets, the S&P 500 and the Dow, finished negative for the week. This is a very positive sign. And in fact, on Friday, the riskier investments went up a lot early in the day and finished the day not as high, but they did finish higher. So this looks very good. It looks like we're starting to see an appetite for risk. Now, given all that, like I said, we've got a potential government shutdown that could throw a big wrench into the gears. So I'm not saying we're going higher next week, but things are starting to look better. And if we look back over the past month, you can see very unhealthy situation with the riskier assets finishing last and the Dow finishing first, but all of them down for the month. And what about year to date? Well, if we look at year to date, we still have a very healthy rally, but we're not up nearly as much as we were back a couple of months ago. So yeah, things have pulled back. I'm afraid to say how I feel. And what if we look at the current bottom dynamics? Well, if you can see what's going on here, as I mentioned last week, we had an attempt at a bottom forming indicator here, but the confidence level wasn't nearly high enough. We had a very strong bottom confirmation here with a very high bottom confirmation signal, this blue line, and the confidence level was very, very high, this dashed black line here. Now, where are we now? Well, right now we have another bottom forming indicator, except this time the confidence level is high. So this is a bottom forming indicator. Now, does that mean we're going higher from here? Not necessarily. There's a lot of things that can go wrong, especially in Washington, D.C. So I'm not going to try and call this one way or the other, but you can see this one is maxed out. It's totally saturated at 100%, and this one's at 0. So I don't know, where do you go from here? And what if we look at risk versus opportunity? Now, these are looking at the old metrics. Well, you can see that risk acceleration just peaked out here almost at 90 and has since just collapsed. And risk, the red line, peaked out just above 70 and has since collapsed. Now, before we developed our new metrics, which I'm about to show you, we would have put risk back on in our clients' accounts when this happens. But I'm going to show you what's happening with the new metrics, and those give me a little bit of pause here. So maybe they're telling something that the old metrics aren't, but we'll have to wait and see. Remember, we're still working to understand how these work and how we can use them going forward. So you're kind of getting the inside view of that experiment with us. So let's look at the new metrics. So if we look at the new metrics, you can see why I just said what I said. Risk acceleration is the highest it's been in this 2-month period, and it's pointing higher. The risk is moving higher. It's above 80. This one's above 90. That's insane. And you can see that the opportunity level has really fallen off here. So, well, hello. I hope you enjoy my cats. Actually, they're not my cats. They're my nephew and his wife's cats. I'm at their house in Kenosha, Wisconsin right now. So you can see that this is not a pretty picture. And if we look at equity versus safety with the old metric, let's follow the NASDAQ 100. So the NASDAQ 100 was down here. Then it went right up to first place, stayed there for a couple of weeks. Then it dropped down here to the middle of the pack. Then last week it dropped down here, almost to the bottom, And now this week, it's coming back up. That looks encouraging. But what about cash? So if we take a look at cash, cash was up here, ranked number 1, pulled back to the middle of the pack. Then it came up here, which was cause for concern. And then it moved up into first place and has stayed there for the last 3 weeks. This is very concerning. I'd like to see this begin to fall next week, and then I'll feel more comfortable that we've kind of seen the worst of it, at least for now. And what about small caps? So let's take a look at small caps. Small caps were down here with the Qs. They went to the bottom. Then they shot up here just like the Qs did. Then they went to the bottom. Talk about dysfunctional. And then they moved up a little bit, and then they moved back to the bottom. And now they're up here above the NASDAQ 100. So this is wild. It's crazy. But I do like the fact that the NASDAQ 100 and small caps have both moved up dramatically this week, at least for the old metrics. So now let's look at the NASDAQ 100. The NASDAQ 100 started out down here near the bottom, moved up a bit. Then it really shot up here to second place, then first place, stayed in first place for 2 weeks. Then it just plummeted to the bottom here, and now it's moved up into 7th place. So it's moving in the right direction, but it still has a ways to go. And what about cash? Well, if we look at cash, cash stayed up here 3 weeks in a row in first place, moved down a little here, moved down a little bit more, and then right back up into first place where it remains this past week. So this isn't healthy yet. It's maybe moving in the right direction, but it's not great. And then let's look at small caps just quickly. So if we look at small caps down here at the bottom, up here, moved up a lot, right back to the bottom, stayed at the bottom, moved up a little bit here, right back to the bottom, and now they're above the NASDAQ 100 in 4th place. So this is showing, at least last week, a very healthy risk appetite. And how does all of this show up in the buying and selling pressure? Well, looking at the buying and selling pressure gives me some hope. And why do I say that? Well, you can see that for the Dow, the SPY, NASDAQ 100, and ARK Invest, you can see that the selling pressure really spiked here for all of them back here. Big pop for selling pressure. But what has it done since then? As they each continued to decline, you can see that the selling pressure has fallen. It's fallen here. It's fallen here. In fact, now the buying pressure is above the selling pressure for the NASDAQ. And for ARK, it's just collapsed, and the buying pressure is coming up. This looks very healthy going into next week. And what about small caps? They've been on a wild ride, and you can see a very similar picture. Selling pressure well above the buying pressure back here, and then just a total collapse on Thursday and Friday, with the buying pressure coming up and now showing higher than the selling pressure. Again, this looks very good. And what about the sector rankings? This is an interesting contrast between the old metrics and the new metrics, and you'll see exactly what I mean in a minute. And as we all know, the markets have not been that great. So I don't know if you can hear the cat sharpening her claws down there. Yeah, you're all right. You're cute. Yeah. What are you doing? Huh? They know I'm filming, so they want my attention. So what did we have last week? Well, in this top table, we had consumer discretionary up here. We had the NASDAQ 100 up here, Bitcoin up here. This week, they almost look like the same thing. All the risk assets are right at the top. This does not tell the story of what we experienced, not this past week so much, but in the weeks prior to that, where equities have just been getting, not trashed, but they've been moving down. But you can see the cash has moved up a bit here. So that's not a good indication. Now let's look at the new metrics and see what that looks like. Well, if we look at the new metrics, I think this tells a more realistic picture of what we've been seeing. You can see the cash was already up here last week, a week ago, and consumer discretionary was here. Consumer staples down here. But what's happened this past week is cash has moved up Treasuries have moved up. Consumer discretionary has moved all the way down here. And consumer staples have moved all the way up here. This really doesn't look good for this last week. Now, these are really looking kind of in the rear view mirror, if you will. So what happens if we look at sector rank acceleration, because that kind of gives you a sense of where things are headed a little more. So let's look at that with the old metrics. Well, with the old metrics, you can see that cash was way up here at the top last week, a week ago, which makes sense because that was a down week. And consumer discretionary was all the way at the bottom. Totally makes sense based on what we were seeing in the market. Now, let's go fast forward to this week. And you've got consumer discretionary now has gone from last place to first place. Wow. And cash, gold, consumer staples, and treasuries, all the safe haven assets have plummeted down here to the bottom end. So this is telling a very positive story for this past week. What about the new metrics? Well, the new metrics are telling a different story here. Last week, 2 weeks ago, we had cash and treasuries up here, consumer staples up here. This looked very unhealthy. Consumer discretionary way down here looks extremely unhealthy. And this week, this is telling us stay away. Cash and treasuries are ranked 1, 2, 3, and 4. Consumer staples has moved up, and consumer discretionary has moved into last place. This is a total conflict with the old metrics, and we're just going to have to see how this plays out and try to understand how to read this going forward. Either one of these or the other is going to be wrong, and we're just going to wait it out. And how have treasuries done this past week? Well, not great. You have an unhealthy situation here with the longest duration treasuries, this purple line finishing last, TLT, the orange line, finishing second to last, and then the shorter duration treasuries finishing, better, but not great. The two shortest ones finished with a slightly upward move. So this is unhealthy for treasuries. What about over the past month? Well, if we look at the past month, very unhealthy situation with long duration treasuries dropping the most. And then if we look at year to date, we are as low as we've been. In fact, we're below the previous low back here. And then let's just go to the maximum. Let's look at the total max here. So if we go to the max time frame, we are below all of these previous lows. So my hope is that this presents a heck of a buying opportunity for long bonds. But if the Fed has sort of started moderating its interest rate increases, and you'll see when we look at the yield curve is becoming less inverted. But why is it becoming less inverted? It's becoming less inverted because the yields on the longer bonds are going up, which is causing the prices to go down. And while we're talking about that, let's take a look at what the yield curve is doing. So this top line, the blue line, is current. And if it were to be uninverted, this end of the curve would be up above the short end of the curve down here, but it's not. So we still have an inverted yield curve here, but you can see it's improved a lot from a month ago, but it's much worse than it was a year ago. And it was about a year ago that the yield curve started to become inverted. And what does the market say about what the Fed's likely to do at their next meeting on November 1st? Well, 82% confidence that they'll leave rates unchanged, and an 18% probability that they'll raise them by 0.25%, which I think would be insane. And if we look at how the yield curve has been inverted over time, you can see that here. So you can see that we've had a huge improvement recently. We were, not too long ago, almost 1% inverted back here, and now we're 47 basis points, or 0.47%, better than 0.5% inverted. So it's moving in the right direction. Hopefully this will continue, but I hope it continues by long yields kind of staying put and the shorter duration yields coming down. But that's dependent on what the Fed does, and we're a ways off for that. So there's a lot of time between now and when this thing becomes uninverted. And how does all of this show up in the buying and selling pressure for treasuries? Well, you can see all the buying action has been at the short end, the safer end. And you can see that here, the buying pressure well above the selling pressure, although it is falling off here toward the end. And then you look at the longer duration ones, and the selling pressure is above the buying pressure in every single case. But you can see that the selling pressure is collapsing at the longer end, and the buying pressure is starting to come up. So hopefully we'll see at least somewhat of a rally here at the longer end, so we recover off of that bottom. And what about gold? Well, not a good time to be a gold miner. Wow. You can see that things kind of noodled sideways and then just absolutely collapsed here. And the selling pressure is through the roof. This is crazy. I don't know what's causing this, but this is not good for gold, at least in the short term. Now, because this is such a big spike in selling pressure, you could see a situation where it's kind of exhausted itself, and the selling pressure starts to fall off here, and the price starts to go up. I'm not going to predict that, but it could happen. And what about Bitcoin? Well, Bitcoin's been somewhat of a bright spot in the markets as of late. You can see that it's been on somewhat of a rally, although it's kind of flat topped out here and pulled back. And you can see the selling pressure was above the buying pressure, but they just crossed on Friday. So no way to tell what's going to happen here. There's so many hurdles in front of Bitcoin and cryptos in general, with the regulators, the banks fighting it because it's going to put them out of business. This has got a long way to go. Look, the equity markets are starting to show signs of improvement. But with the looming government shutdown ahead, anything's possible next week. Until then, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.